Hi, I'm Ben Wallace, Research Director and Portfolio Manager at Grimes & Company. Each quarter, we develop a series of outlook themes to put the current market environment in perspective and lay out key drivers for the upcoming year. One common client question we've been getting recently is, amidst all the uncertain headlines, why has the market been so resilient? An important part of this has been the AI investment cycle. This generates the follow-on question, is this a bubble? Looking at prior examples, such as railroads, electricity, automobiles, airplanes, and telephones, innovation cycles can go through multiple stages. In the first stage, a new technology is developed and it's rapidly deployed as it catches on. This typically benefits the founders or the inventors of the product. The second stage, we see profits reinvested, often from those founders, and that continues to fund the growth. The third stage, we see outside investors join in on the investment. This adds to the growth and can lead to wider adoption. The concern is that leads to a fourth stage, which is a bubble. That occurs when additional investors come in, put in additional capital, and we see the growth of the technology rise, but the fall on potential returns decline. This can result in either a valuation bubble or a fundamental bubble. A valuation bubble occurs when expectations of the initial stages are projected into the future and result in current prices being higher than perhaps they should be. A fundamental bubble occurs when the capital deployed starts to see its returns fall because the technology has become more ubiquitous. AI is certainly going through an innovation cycle. Up until now, major investors such as Microsoft, Alphabet, Meta, and Amazon have funded a large portion of the AI build-out through internal cash flows. But unlike software, web services, and social networks, AI is capital intensive. This cycle seems to have shifted it into a new gear. A notable event was on September 22nd when NVIDIA agreed to invest $100 billion in OpenAI. This allowed OpenAI to turn around and buy chips from NVIDIA. The emergence of a new technology and surging share prices have generated comparisons to the 1990s dot-com bubble that peaked in 2000. One way to look at this is to use the November 2022 introduction of OpenAI's ChatGPT as a start date for the current period and compare it to the 1995 to 2000 period using the introduction of Netscape, often seen as the start of the dot-com boom. This is shown on this chart in the gray line. We can layer over it a blue line for the 2022 to present period. As evident in this comparison, the blue AI line has only reached 1997 on the gray 1995 to 2000 line. Yes, it is higher, but the cycle still had room to run. However, you can also look at the recent NASDAQ rally starting in March of 2020. Amidst the early days of COVID, work-from-home protocols spurred a boom in cloud computing. And this cloud computing boom is the foundation for which the OpenAI build-out is relying on as its foundation. If we were to layer this period in with the red line starting in 2020, you can see that the current cycle has actually reached the 1999 period, although the peak is much lower. This allows us to have two scenarios to bracket the current set of outcomes. If this is just 1997, that would suggest the current rally has legs and can continue to run. On the other hand, if it's 1999, that would suggest we are near the peak of the cycle. However, in this case, at least the peak is lower, so perhaps the potential damage is less. The recent shift in cross-funding, debt funding, and surging data center capex certainly bears watching. Yet at the same time, current demand is outstripping supply, suggesting returns on investment can continue. In fact, looking at the 1995 to 2000 comparison, you can see how, after the 2001 decline, the market was barely higher than 1997. A cautious investor in 1997 would have been right, but it would have taken 4 years for them to see that borne out. No two market cycles are ever identical. For the market and economy to continue to deliver, it must answer the question, is it 1997 or 1999? The importance of AI will have on the markets is being closely watched in data points from corporate earnings and in the data. For clients, it means having a properly diversified portfolio. It means not chasing AI by going all in on technology stocks, but also means not hiding all of your money under a mattress. The key to all this is risk management tools where applicable. And most importantly, the key to all of this is having an advisor who understands the individual client's needs and risk tolerances and can put them in the appropriate mix of strategies and assets. That is the foundation of our process. For more quarterly outlook themes and insights, please visit grimesco.com. Thank you.